You're listening to a production of the National Media Archive. To learn more or volunteer, go to nationalmediaarchive.com.
Why is it that in a country as vast as Canada, owning a home feels so out of reach for many, especially in cities like Vancouver and Toronto? The contrast between our land size and our real estate woes is striking. Here's a staggering fact. Canadian home prices have doubled in the last decade, while hourly wages have only risen by about 24%. That leaves the average household needing an income of $180,000 to afford a $750,000 property, but the median family income is just $121,000. Take Vancouver, for example. A modest 3-bedroom, 1,949 bungalow recently sold for 5.5 million Canadian dollars. Even after adjusting for currency, this is far beyond what most families can manage, making homeownership a distant dream for young Canadians. Some might say, isn't Canada underpopulated and full of space? Why can't people just move somewhere cheaper? The truth is, over 75% of Canadians live in urban centers, where demand far exceeds supply, and moving isn't a simple solution for jobs and family. So, as we unpack the roots of this crisis, keep in mind, affordability isn't just about price tags. It's about supply, demand, and policies. Understanding these factors is essential for anyone thinking about entering Canada's housing market. If property prices keep climbing, can we just build our way out of the problem? Let's explore what's really fueling this supply-demand imbalance in Canadian housing. Canada has the lowest housing supply per capita in the G7, just 424 units per 1,000 people. The Federal Housing Agency says we'd need 5.8 million new homes by 2030 to restore affordability, but we're only on track to build a fraction of that. Case in point. In Toronto, zoning restrictions mean the majority of land is reserved for single-family homes. That's why a house's zoning, not just its size, can send its value skyrocketing, as seen with the 5.5 million bungalow I mentioned earlier. Critics argue, can't we fix this quickly if we just relax restrictions and let developers build? But it's not that simple. Skilled labor shortages, red tape, and even political scandals like Ontario's Greenbelt controversy have slowed progress drastically. Looking ahead, meaningful progress will require coordinated policy change, accelerating permitting, investing in skilled trades, and rethinking urban zoning. Until then, Canada's housing crunch will likely persist, especially in major cities. With home prices at record highs, are Canadians risking too much by taking on more debt? Let's examine how borrowing has shaped and threatened the real estate market. By late 2022, Canadian households had 1.85 of debt for every dollar of disposable income, the highest in the G7. A whopping 75% of that debt is tied to mortgages, making Canadians some of the most indebted people globally. Consider the story of homeowners who bought during the pandemic at ultra-low rates. When the Bank of Canada hiked its policy rate from 0.25% to 5%, their monthly payments jumped from $1,890 to $3,222 on a $500 mortgage almost overnight. Some argue, but isn't most of that debt on fixed-rate terms? Won't buyers be safe for years? Unfortunately, in Canada, fixed usually means just 5 years. Over the next 5 years, nearly every mortgage will reset at higher rates, exposing buyers to sudden shocks. The lesson here is clear. If you're considering homeownership, focus not just on today's prices, but your risk tolerance for rising rates. Long-term planning and financial discipline are more important than ever in this volatile market. Given record debt and soaring payments, why hasn't Canada's housing market crashed? Are we just in the calm before the storm? Or is there more resilience here than meets the eye? Surprisingly, mortgage delinquency rates remain near record lows, just 0.15% as of the most recent data. Canadians built up significant cash savings during the pandemic, boosting checkable deposits by 40% from 2019 to 2022, which has helped buffer against higher payments. Let's look at Toronto and Vancouver, where many buyers are holding on, waiting for better conditions rather than selling at a loss. RE/MAX reports highlight low loan-to-value ratios and shrinking numbers of buyers with poor credit signs of a more cautious market. Still, Skeptics warn, doesn't high debt eventually catch up with everyone? Aren't we just delaying the inevitable? That's a valid concern, especially as more mortgages reset and if government policy doesn't address underlying supply and affordability issues. For now, the best move is to focus on what you can control. Keep housing costs below 32% of your pre-tax income, build savings, and get professional advice before making big decisions. The future is uncertain, but preparation is your best defense.